G'day, my name's Matt Grimwood and this is our First Home Buyer's Guide produced by Heritage Media. So there are a lot of confusing steps and common topics that are spoken about when you're buying your first home. Now, one of the topics that has most of the questions is around interest rates. What are they? How do they affect the property market and how do they affect people when they're buying and selling houses? Joining me today is Darren Butcher from Wisebury Heritage Real Estate. Darren's an award-winning real estate agent and the best person I could think of to cover this topic with me. Darren.
Thanks, Matt. That's really nice.
Thank you for joining me.
Oh, it's a pleasure, always.
So could you give us a bit of a background into where you started in real estate?
Yeah, look, it was very, very early, and I'll probably start that step before where I actually went to uni and from school to uni to do computer science, and it just wasn't for me.
Yep.
I dropped out of that, got a job in Wideline doing windows and doors and realised that wasn't for me. And then I knew that I was a salesperson. I knew that inside. And so I went and got a job for Ruben F. Scarf, and wasn't long before, I was headhunted by heaps of people every day to come and work for them. And the one I selected was real estate. Dad was a real estate agent for 20 odd years before I actually got into real estate.
Wow.
And it was something that was always in the back of my mind I could go to, but I was young at the time. So I thought, well, I better have some time out and then come into it later. But the passion was there and I was good enough and I got asked. So the place that he first started was the place that asked me to come and work for them. His office that he worked for was already full. So I started as a competitor in Gorican. He was over in Toukley and just things took off from there. And then we joined together in 1994, 1st of March, where we started Heritage Real Estate Group.
Right.
Wasn't long before we grew and Mum come and joined us. And then it wasn't long before that and other people come and joined us. And now Wisebury Heritage is a franchise of Heritage it's Wisebury's a franchise and we're a Heritage and put them two together and we've got what we've got.
That's awesome.
Yeah.
Today's topic is all about the different kinds of property markets that we can be in.
Yep.
So could you give us a rundown on what the different kinds of property markets are?
Yeah. Look, there's two specifically. One's a buyer's market and one's a seller's market.
Yep.
So to give you a guide on a seller's market, we come out of that around about 3 to 6 months ago, and that's where there's more properties on the market that are sellers, that are buyers than there are sellers. So if you've got one property on the market and there's 10 buyers that are out there, that's going to force competition and prices are going to go up. And that's what was happening consistently.
Yep.
And buyers were outbidding each other, and that was because there was only one there and they wanted to have that one. So that actually raises prices. Now the buyer's market, which we see ourselves in now, is the opposite, where there's more properties on the market than there is that buyers that are out there.
Right.
And what actually happens is when there's one property on the market, there's 5 properties on the market and one buyer, then you're going to find that it's not long before prices start to trickle back, where the owners of the properties actually start competing to get that one buyer.
Right.
And so that's where we're at the moment. It's a great time to be a buyer.
Yep. So as a first home buyer, your ideal market to buy in would be a buyer's market.
If you could, yeah. Look, you don't always get a say, and I suppose it comes, and some people are unlucky because the uptrends are at that time of life where they're somewhere between 18 and 25 where they're going to buy their first home potentially. Some people are older than that, so please don't think I'm stereotyping there, but that's where you get a larger group. And then you'll also have the market up then, so they're buying sort of at a peak of a market where there's another group that actually might be, say, the same age group, or 18 to 30 or 18 to 40 or whatever the case may be, that actually are buying it and it's in a down market. And so it just happens to be the time they're ready to buy and stuff. And that's where we are now. So some people are a little bit luckier because of the age demographic or when they're born.
Yep.
But I can say to you, if you're now, you're pretty lucky.
Yeah. Nice. Is there certain things that determine a change from a buyer's to a seller's market or a seller's to a buyer's market? Is it the amount of properties on or?
Yep. But look, it is the amount of properties on, but that is actually adjusted and it's a confidence thing.
Yep.
So the market actually looks at itself and it goes, okay, well, it's a great time to buy or it's a great time to sell. And so that they get more confident with that because of that reason. At the moment, inflation's really high. And so it's actually interesting. What that means is the cost of lettuce might be more, the cost of petrol might be more, the cost of a beer at the pub might be more, and everything's costing more. And unfortunately, what actually happens when that happens is that the Reserve Bank has to get control of that, because if it goes too high, then wages have to go up higher. And if wages go up higher, that's just forcing that whole issue there. So they get to a point where they have to adjust it. And the way they adjust it is through interest rates.
Right.
And so I know today's topic is on interest rates.
Yeah.
And so that's how it's dealt with, through inflation.
Right. So we just spoke about interest rates. Could you give us a rundown of what interest rates are?
Well, interest rates, there's a cash rate,
Yep.
which is done by the Reserve Bank. And the cash rate is actually a margin that they say that it is going to cost to lend money out. And so the banks put their margin on top of it. So the margin of a bank might be, say, 2%, for example,
Yep.
and the cash rate could be 1%.
Yep.
And so that would make 3% out in the marketplace. So when you hear there's a 3% interest rate, that's because there's a cash rate and then there's that market rate on top of it. So,
Right.
yeah.
So how does that affect the property market? So if you're buying a home, your interest rate
Yes.
is added on top of what you want to buy. So if you want to buy a $500,000 home,
Yep.
you got to pay that $500,000 back plus the 3%.
Yep.
If you get a fixed interest.
Yeah. Look, there's two different interest rates. So there's principal and interest only.
Yep.
So not to confuse things, as an investor, you'd probably do an interest only. As a first home buyer, you'd only be probably offered from the bank's principal and interest.
Right.
So what that means is they're going to give you the money that you need to buy the home. Hypothetically, let's say it's $1 million. I know it's probably not, but let's say it's $1 million, and they give it to you, and they say your principal and interest might be 3.5%. Now, at 3.5%, it means that you pay $35,000 in interest, but they'd also want you to pay some of your principal off. So you're at the end of the loan, you don't end up with $1 million after 30 years.
Yep.
So what they do is they then have a trickle back of what that would cost, and they add that on top of it,
Yep.
and then they divide it by 12, and that's how they give you the interest rate.
Right. Interesting. So you see on the news and in the papers and all that sort of stuff, they always talk about the rise and fall of the interest rates. Who sets that? What's determined for those rises?
So the Reserve Bank sets it, and they're the ones that have the cash rate. They're the ones that set that margin. But the actual where the interest rates are is set by the banks.
Right.
The banks have a regulator, which is called APRA, which says you can't put too much margin on something. You can't be unfair to the people and all the rest of it.
Yep.
So they've got a margin definition, and they work with that. So, roughly it could be anywhere from 1.75 to 2.5% as a margin for some people, and
Yep.
it could be much higher for others, second tier and third tier lendings and things like that, which is another day.
Yep.
But the truth is, at the end of the day, the person who sets it is the bank, based off what they want to put their margin on top of the cash rate.
Right. So interest rate rises and falls in relation to buying your first home. How can that affect you?
Okay. So what you'll probably have to do is, if you're buying a property at the moment, you'd have to budget for 6 to 8%. It'd be where the interest rates go. Can you afford to pay it if that's the case?
Yep.
Now, it doesn't mean that's what you've got to pay. You can lock into a rate and things like that, which you can discuss with your broker or your solicitor or whatever the case may be. But the truth is that, if you allow for that, you've got a buffer. So if the rates do go up there, you're comfortable. And what I would say to people is that, you're probably borrowing around the 3.5-4% mark, although on Tuesday they're looking to probably do another 0.5% potentially. So, just be mindful that it could go up and make sure you've got a little bit of a buffer to the side of it.
Okay, awesome. Yep. So do you have any advice for someone who is looking to get into the property market or looking to buy their first home?
Yeah, I always say buy when you can, because, look, interest rates will go up further. Prices of properties could come down further. But the problem is, if you actually jump into the marketplace too late, you might find that you're actually on the swing of the opposite direction. So when you get to the banks and you ask for a loan, they might ask you for different details. It could be bank account statements. There's lots of different things that you're spending, why you're spending it here, what's actually going on. And they might ask you to do a 3 or 6 month plan to wipe past debts or zip pays or whatever the case may be.
Yep.
If that's the case and you actually are at the bottom of the market when you're buying and you get asked to wait another 6 or 12 months, you are then going to be spending money where it's rising.
Yep.
And the interest rates at the moment are competitively low. You can do lock in, so you can actually have a 2-year, 3-year, 5-year fixed loan if you want to, which means that you can lock the price in. It'll be a little bit more expensive than the current interest rate, but you can have that so you know exactly what you're paying for to 1, 2, 3, 4, 5 years.
Yep.
So that's something that can be done. But what I say to people is, now, if the right property's there and you can afford it, it's probably a good time, because at 4% interest rates, you might be able to afford a certain property, but at 6% interest rates, you mightn't be able to afford that same property. So whilst it's $50,000 cheaper, you might not be able to make the repayments of it.
Yep.
And so what it actually says is, look at the market now and see. And if you can afford to get into the market, then do it.
Yeah.
Once you've got your foot in the door, whether it's small or big, it doesn't matter. You've got your foot in the real estate door.
Yeah. So when you're trying to get into the market, in your experience with helping, I'm assuming a lot of first home buyers,
Thousands,
get into it. What are some of the things that they should look out for when they're buying a first home? What are some of the contributing factors that you go, okay, that's a good step in the door?
Well, the first thing I'm going to say to you, which you're not going to listen about, but the first thing I will say is that don't get what your mum and dad's got.
Right.
They've worked all their lives to get where they've got, and you don't need to have something as palatial as that. And whilst everyone will ignore, because I understand how the thinking is these days, the best investments the best things that I can see is that the smaller you start, the bigger you grow, or the sooner you can grow. And the value in real estate is in the land, not actually in the property. House prices will go up to build, but very small amounts. At the moment, it's probably 30% is the largest I've seen. They grow over a short space of time. But the land is where the price really escalates. And so what I'd say to you is buy a nice block of land with a house that's going to be suitable. You might think that you want a 4, 2 and 2 with a double lock garage and all the rest of it, but you might be able to get away with a 2-bedroom home and save yourself a couple $100,000.
Yeah.
That couple $100,000 then can be something that you actually, work on paying the house down, get a bit of equity into it, and then look at buying a second one.
Yep.
So instead of you having one when the market changes, and every 10 years real estate generally doubles.
Yep.
I'm not saying it's the case all the time, and I can't give that financial advice, but what I can say is tradition, it seems to have done that. And so in 10 years' time, if it is worth double and you had 2 of them, you've doubled down.
Yeah.
And that's where wealth's created. So for me, the best way I can explain it is those that actually had the old crappier cars and saved a lot early and all the rest of it seem to be the people that actually at the end of the day had the most. Those who went and bought the palatial properties and all the rest of it seem to be the ones that struggled the most.
Yeah.
So I'm going to say to you, buy a little bit less than what your means are.
Yep.
Get something that's great. But if you've got to do work to it or whatever the case may be because it's older, then that's okay.
Yep.
Where you don't have to have what your parents have had. That's the best advice I can give you.
Yeah, no problem with taking baby steps into.
Look, it's you've got to crawl before you walk, and I think gone are the days where you used to buy a block of land, pay the land off, then you build a home, and that those days have gone, and it has changed. But I think gone are the days also where you actually dive in too big, too deep, and remembering too, people only 12, 18 months ago were paying 2% interest rates. And now there's a possibility it could be 6+.
Yeah.
That's 3 times the amount. Just got to be careful with that.
Yeah.
So whilst the people yesterday could have gone and bought a 4, 2 and 2 and be probably quite comfortable now because their market went and all the rest of stuff that's there, you today are on a different playing field to them and you've got to think differently.
Yeah, absolutely. So as the owner of Wisebury Heritage, I suppose the best thing is to ask how to contact the company. What's the best way to get in contact with you guys?
Yeah, look, I've got some fantastic agents out there that'll help you and walk you through the process of what you need. We've got buyer packs that you can come in, you can get a pack and it'll explain the process and how you do it. It talks about the podcasting as well, so you can listen to what a first home buyer should listen to. But we can be contacted by coming into either of our offices. We've got an office at 35 Wallara Road, Gorican, and the phone number for that is 43 922. And that's our Gorican office called Heritage. And then Charmhaven, Wisebury Charmhaven is 4392 0700. Nearly got that wrong. So that's 4392 0700. And that's at 170 Pacific Highway at Charmhaven next to the Secret Cafe. Pop into either. They'll take you through step by step what you can do. And they can start to then say, okay, well, this is what you need to do next. But hopefully that can help you. Awesome. And the other step to take is maybe go over to a broker or a bank and ask them what they think that your borrowing capacity is and how could you improve that? What is something that you could do to actually improve it? And they might say, consolidate some personal loans, pay off some debts, stop spending money, through the tab or whatever the case may be. So good tips, little tips to get you a match fit. Yeah, awesome. Thank you very much for joining me on this, Darren. It's been very insightful and there's been a lot of great information in there. Thanks, Matt. Hope it helps someone. Awesome. Thanks, mate. Perfect.